Okay, record to computer. Here we go. All right, so we'll get started. Um, so today we're going to go over solving the contingent sale. We want to make sure we're providing options to our referral partners on how to work with contingent buyers and potentially remove the contingency, and then also talk about some solutions to help them pull equity out of their current homes for down payments. Again, turn their contingent offers into non-contingent offers, and then offer some temporary housing solutions as well. So my name's Megan Wentland. I'm one of the branch managers at Fairway Naperville, and I'll let everybody just do a quick introduction of who they are really quick. Don't all jump at once.
Hi, everyone. Scott Helverson, co-branch manager at Naperville Fairway as well.
How about Tony?
I am Tony
Gajewski,
Tabrizi.
Oh,
Go ahead, Scott.
I think no, Tony. What? Oh, okay. I was gonna say you got it first, but
Scott Gajewski, Fairway Loan Officer at the branch.
This is Tony Tabrizi, also with the Naperville branch.
Dave, you're it.
And I'm Dave, loan officer at Fairway in Naperville.
All right, and Karen, we're going to have Karen go first. She has a temporary housing solution for us. If you have clients who are, needing to sell, and sometimes there might be a few months between moves, maybe they're buying a new build, and they just have a few months between closings. So let me get her PowerPoint shared here. Okay.
All right. So I'm Karen Outlaw. Can everybody hear me? Just making sure I'm not muted. Okay, good.
Yeah.
I'm Karen Outlaw with Apartment Solutions. I have been here, just a little background, since 2011. So it'll be 15 years this summer. I actually came here originally looking for an apartment, and in my own personal transition. So when I found out they were hiring, loved the mission, and I partner with real estate agents, transitional housing, and mortgage brokers. And what we do is we match people with apartments based on their wants, needs, and qualifications. So anything from short term to long term is what we can, help match a client with. So if you want to go to the next slide. Yeah, you can just pop them all in, I
Okay.
guess. Yeah, that's totally fine. Yeah. So basically, clients that are, rushed into making a decision, maybe they purchase something without having all of the knowledge, those can be very, very stressful situations. So having that transitional housing, in place is can be very helpful and actually save deals. And you always want repeat customers. So if they feel like you did the right thing and gave them that interim solution so they could make the right decision for themselves and their families, then that's always the best thing to do. So I know, like Tony and I have talked, there's quite a few clients that can't, hold two mortgages. And, that's obviously what this is all about, the contingency. And, a lot of times the house may sell better when they're not in it. Maybe there's needs to be renovations done. Maybe, it just works better for showings. And having that, 3 to 6 month lease in place takes the pressure off and often results in a better financial situation for the client. Let's see.
Next slide. Or
Yeah. Yeah. So we're a free service for the client. So yeah, you can just pop them all in. It's fine. We're a free service for the client. So Fairway isn't paying anything for it. The real estate agent isn't paying anything for it, and neither is the client. We get a one-time commission that's paid by the landlord. or the management company. It's accounted for in their budget. It's part of an operating expense. So their rent is going to be the same as anybody else coming off the street, whether they utilize our service or not. We work with volume, so they definitely want to work with us. As far as the short-term leases, recently I've had quite a few people that are looking to build, and those can be really good situations, when somebody sells and they're looking at a build. Builds, as we all know, are not always done on time.
No, they're
Yes.
always on time. They're
Right.
early.
I mean, right,
No.
right.
No.
They get rushed to close when the house isn't ready.
What, Tony?
I said they get rushed to close often by builders.
Yes.
Mm.
Yeah. And then, right. And then, yeah, it can be a headache. So having that extra little buffer in between. I mean, we are in the Chicagoland area, so to the builder's defense, we don't know what the weather's going to be. We don't know, there's so many factors that go into that. So basically what we do is, none of what we're doing on our end, it has anything to do with the actual mortgage. It's not going to like hugely negatively impact, one way or the other. It's just going to offer that buffer so that they can make the right decision on their next home. Some clients, need a little bit of time to do some credit repair or get some finances and things in order. And we're able to offer that. One thing that we can do is we match. I just had a client referred to me from a real estate agent a couple weeks back, and she wanted to have something in that specific school system and not just the school district, but she needed it to bus to and from her child's middle school because she works in another town. And there isn't after school care, once you hit middle school. So we were able to match her based on, which properties feed into which schools. That's a very, very common case when someone is in between homes.
Awesome. What a good service. Because it's so needed. I hear this all the time. Like, it's just, I have nowhere to go. It's kind of
Right. And so then they might not sell, or they might not
Yeah.
purchase something new.
Yeah.
So, and they definitely don't want to live in the in-laws.
Yeah.
house.
Or they don't want to settle for a house just because they're up against time, So
Exactly. Exactly. So yeah, this is we're able to match based on, pets, school system, number of bedrooms. I recently had somebody that needed a walk-in shower. That one's becoming more and more common. Elevator building, private entry. There's so many different factors, and my area of focus is DuPage County, a little bit into Will, Kane, and Kendall. And then we have a Northwest Suburbs office that handles like suburban Cook. So like think Schaumburg, Arlington Heights, those areas. All the way up to like Northbrook, Gurney.
Well, we're going to share this PowerPoint with everybody so they have your contact information. And of course, they can always reach out to us as well.
And
To
Karen, do
get
you
in touch.
have before you go, do you have like an average price on what you're seeing for rents, or does the client give you their parameters of kind of their comfort level, and that you'll use that in the search as well?
Well, of course, I'm going to use that. Their wants, needs, and qualifications always are a factor. So yes, we want them to be as comfortable as possible. Realistically, on a short-term lease, it depends on the time of year. Because if the lease is going to be ending in the spring or summer, those are going to be less expensive than if they're ending in the winter months. And less properties will offer them during that time. So supply and demand, of course, factors in. It really depends on the property. I would say on the very low end, like best market situation, maybe about $2,000 a month on average. And it can definitely go up from there. The lady that we got in, I think we got her in right around, and she got a 2-bed, 2-bath. and it was the Lombard area. I think she was right about 2,300.
Cool. Great. And then you'll send a whole like list of potentials, right? And then the client gets to look over and pick what they think would work well and set up
Yeah,
showing.
so I'm going to narrow it down. So they're not just going to be driving by, an apartment building and walking in and finding out, nope, ours is 7 months, oh, well, we only
Got
need
it.
3. The one thing that I am limited on is like 1 and 2 month leases. They're not really a thing. They're better off.
Like a per month.
Yeah, they're better off finding some other temporary situation, 3 month and above.
Got
And
it.
it
And
doesn't
if I
have
may
to be a
chime in
3 or
quickly,
6.
so this is an advantage for someone who has that contingency, and now they are willing to list their home with their agent,
Hmm.
work with Karen to find a temporary place to stay at based on the parameters they have.
Mhm.
Then they could easily sell their home and move into this place while they're comfortably shopping for the home that they were going to purchase or build or whatever it may be. So
Hmm.
that transition during that sale of the house, during the move-in into their apartment, we're really not involved because we're working on the pre-approval for them to buy that next house.
Right.
But now they could sell their home, they make the money, it's in the bank, there is no DTI issues, and it just solves a lot of issues.
Or to Karen's point, she made it, and then my brain went to credit. Like a lot of people have debts that they want to pay off with the proceeds
Correct.
from the sale of their house, right? And they may not qualify credit score wise because that debt to income ratio is kind of so out of whack on their credit cards. So they could pay off all their credit cards, have a temporary housing situation for 3 months while their score builds up, and then they could
Correct.
have a better interest rate on their home, better DTI, all of that kind of stuff. So that's a great, I mean,
Yeah,
And we
that was
could
the
do that with
situation for this client that I just placed is the debt to income ratio. She was getting a lot of money out of it, but her credit, took a little bit of a hit
right, because
over the
their cards
last
are
couple of
maxed
years.
out.
Yeah.
Right.
Yeah.
And we could do that too with the bridge loans we're going to talk about next. But the problem with that is usually it takes time, a couple of months for the credit bureaus to reflect those
Right,
accounts that were paid
exactly.
off.
That's what
So
I
it's
was
not going to be
thinking.
immediate. You could pay it
Yeah.
off if you want to get the debt paid off. That's fine. But if you need it for the scores to improve, then
You need
it
some
takes
time.
2 to 3 months usually.
Yeah.
Right.
Well, that's awesome.
So yeah,
Well,
I'm
thank
always
you.
happy to answer any
Yeah.
questions. I did leave my cell phone on there. I'm always good to text. We also do a little bit of property management as well. So if you have somebody that, maybe isn't selling or maybe is investing, we're always open for those opportunities. And yeah, any questions I can ask. I'm very an open book, and just, wanting to do the right thing for the client.
Thank you.
Great.
We
Thank you.
appreciate you.
Yeah, not a
Thank you,
problem.
Karen.
All right. Well, I hope you guys have a great day and a great rest of your meeting.
Thank you.
All right.
All right, so we'll jump right into bridge loans. So you may have heard of a bridge loan before, but what is it exactly? And Fairway has a proprietary bridge loan that we offer. And basically what it is it provides short-term financing for a new property until a borrower can sell their existing home. Like we said, it's literally a bridge from their old home to their new home where they can pull equity out of their current home for down payment and debt payoff on a new home. Something unique that I recently learned with the bridge loan is that you can actually pull the equity to pay off a mortgage if you need. If they currently have, like I had a client who had a super small mortgage left on the property, they can take the equity out to pay off that mortgage, pay off debt, and make a new payment or make a down payment on the new property. So it's ideal for clients who need to quickly relocate, new job, something like that, or maybe they want to make a strong offer with a higher down payment on a new house. Maybe they only have, a small down payment, 3 to 5% in their savings, and they don't want to pull money out of retirement investments when they have all this equity sitting in their home. And then maybe growing families who need more space right away, divorce situations. We see this a lot in individuals who need to pay off debt or secure a down payment. So that's kind of who a bridge loan is for. So some details, you can get a loan amount up to $750,000, up to 90% loan to value. So I'll use $100,000 just for easy math, obviously, but if they are listing their home or their home is worth $100,000 and they own it free and clear, they can pull up to 90% loan to value, so $90,000 in the form of the bridge loan. But there's a minimum of a 680 credit score for this. So not for every single borrower, but 680 is pretty generous. We see most borrowers around that range or higher. It's available in all states except Texas and New York. So obviously here in Illinois, it's good, but all states except Texas and New York. And the eligibility is based on the location of their departing residence. So not the location of the new home. So if they're moving to a different state, that's okay. But we base it off of the departing residence. So I do know if their credit score is lower, we can still make it work. It's just they won't let you go up to as high of a percentage of loan to value. So the lower the credit, the lower, they might only let you go up to 70 or 80% loan to value. Now, potential, I don't want to call it a downside, but just a reality of the bridge loan is we still have to include the departing residence. So the home they're going to sell that we're pulling equity from, we still have to include those property taxes and insurance in their debt to income ratio. So they would have to qualify for the new house payment and also include their current property taxes, insurance, and if there's a mortgage on the property, of course. But we don't have to add the bridge loan. It's not like a home equity loan where there's going to be a payment. We don't have to add that payment into their debt ratio. So right now I have clients who are actively going through a bridge loan process. They're pulling $130,000 from their current home for a down payment on the new home. And we don't have to count any kind of payment on that $130,000 that they're borrowing. Only the taxes and insurance on their current home because they happen to own it free and clear. And we are actually taking some of that money to pay off all their debt, make their down payment on their new house, and then we're going to do what's called a recast after they close and sell their current home. But they want time to stage it, to get out of the home, and they can't qualify with two mortgage payments without making that large of a down payment. So it's ideal for them. And it's, like I said, it's a great proprietary product for Fairway. So bridge loan is definitely a solution you want to present to your clients, your move up buyers, your downsizers. Take it, this information on a listing presentation. If you have a client, you're shopping with who's contingent, this might be a potential solution. So to get them in the home sooner. So now buy before you sell.
Okay, so this is a product offered by HomeLight, one that I feel like it's the fastest, more convenient, probably the best customer service in regards to the work they do with us. All of them are good, but this is another option for all the contingency buyers where we qualify them to buy the house that they're interested in, come back and sell the other one. They could get equity they could get money fronted to them out of the equity of the home that they're selling. We call it the departing residence, based on what they owe on the house, what the house is worth, what their qualifications are, etc. And that money will be ready for them for the purchase. The way that process works is me as the loan officer will submit the departing property information to HomeLight, some photo of the property, some basic description, how much they owe, what's the value of it, just general stuff. HomeLight reviews it and they give us a conditional approval with the equity unlock estimate. So they say, okay, for this house, they could get anywhere from $75,000 to $100,000. Then that's something we discuss with the client in regards to how much they need. Do they need more than that? Is that sufficient? Sometimes if they say they need, $100,000, and the equity unlock is more than that, they could opt to take that to pay off some debt or moving expenses and stuff if they wish to do that. They just make less when they end up selling the house. So now once we get the conditional approval, we're good. They could start looking at the house they want to buy, keep moving around, keep negotiating, all the stuff that goes with finding the right home. And along the way, I'm here to make sure that things are up to speed with their approval and so forth. Now they go under contract, they buy the house. At the time of closing, there's our wire, there's the money that they're bringing to closing. Maybe they're not bringing anything to closing because there's a wire there from HomeLight that is toward the closing, toward down payment. So they close, they get the keys, they move into the new house. Now they have the ability to stage their home, clean it up, multiple open houses, and the things that you guys as realtors are familiar with how to exceed their expectations, your seller, and get them a good price on it. You have 120 days to sell this home. If during that time period something happens and you can't sell it, HomeLight will buy the home at full price, and all the commissions, everything stays the same, and then they will have the agent sell the house, and they still get paid. So usually it doesn't happen. 4 months is plenty of time to sell the home in this market. And there's a lot of safety checks ahead of time during the pre-approval process to make sure that the seller could do the things needed to prepare themselves to sell.
Tony, what if
So
my
here,
house doesn't sell in 4 months?
HomeLight will buy it. So it still sells. So HomeLight will buy it, and then we'll get with the same realtor to list the house and sell it. They're not in the business of buying homes or selling homes.
There's
So,
also an option if you don't want HomeLight to, because HomeLight really doesn't want to buy the house typically.
correct.
So there's also an option. I personally had this situation where they do allow for extensions for an
Yes,
increase.
there's always extensions
Yeah.
and things that they could work out. But the idea is during that 4 months, they should be able to sell it. If it doesn't sell, they'll buy it and work with the realtor to come and sell it. But usually they'll work with the client to extend it another 30 days, 60 days to make things work. Because it just depends on circumstances. Maybe it's winter months, or maybe there was an offer that fell through, or whatever it may be. They're pretty lenient.
Yeah,
So
they're
there's
pretty
a scenario
flexible.
here that I'll kind of read over quickly. So we have a sale price of $500,000 on their departing resident. This is the house that they're selling, and they owe about $250,000. So once I input it into HomeLight, HomeLight says, okay, well, of the equity available of the 250, we're willing to give them $100,000. And if our client is comfortable with that money and they're needing to put somewhere around that much for the purchase of their next home based on the scenarios that we ran for them for their purchase, then we're good. If they need more money, that's not a problem as long as they have it. If they need less money, then they don't need to use all of it. They just use the chunk that they need. They could also use some of that to pay off credit cards or other debt if they want, to just reduce their expenses once they move into the new house. So that could easily be done. So once that part is figured out, then they start shopping for the house they want, like we talked about. They close, they get their HomeLight money, and we stay in the process of helping them with the next stage. They stay with the same realtor, nothing changes, and it's a pretty smooth process. I've done it a handful of times. I love it. The HomeLight customer service is very supportive. I mean, they have all the
Fast.
answers, they have all the resources, they're quick to respond, and it just makes the transition for the buyer really easy. So I really endorse it. I do think it's a great program, and if you need more details or some of the nitty-gritties, just reach out and we'll walk you guys through it.
I want to share a quick personal story about how it saved a potential deal. For me, I had buyers actually get their offer accepted contingent, but then a cash buyer came in and bumped them, and they had 48 hours to remove the contingency. And it was, of course, a Friday afternoon when that happened. So HomeLight actually, we submitted the application Friday morning, had the approval by Friday night, and were able to drop their contingency and save them from getting beat out on a cash offer. So that's probably not a common situation, but just wanted to share like an actual story of something that actually happened in a situation where, think about if you're the realtor who offered that to your client and was able to save a deal because of that, your client's going to be forever loyal to you. And it's going to, this product that you present to your clients is going to set you apart because maybe another realtor they interviewed didn't even offer it or know about it. So it's just another tool in your tool belt. So just wanted to share that story.
No, that's a great point because nothing is common. Every
Right.
transaction has some issue with it. And
Yeah.
this is a great way. All of these contingency options that we're discussing today is a great way to ease that whole process.
Yeah.
All right. I want to talk a little bit about something very similar to HomeLight, but it's our other kind of Plan B option, for buy before you sell. It's a trade-in mortgage by Calque. So it's same principle as HomeLight, where you'll get a guaranteed backup offer, cash offer, which allows us to remove the housing debts on a conventional purchase on the new house, and allows clients to buy a home essentially without having to sell and having to worry about the mortgage payment that they currently have affecting their debt to income ratios. So this one works, very similar to HomeLight. Calque offers a binding backup contract on the client's home. We do that up front. We'll do a quick application, get some pictures on the home, and get an offer put together by Calque. Happens relatively quickly within a few days to a week or so. Then we subsequently pre-approve the client for the new home so they can get out there and make offers, and do non-contingent offers, which is going to help them be a lot stronger in this market. And then the Calque offer will be worked up, and there's a couple different ways I'll get into, but how that breaks down. But essentially, your client will close on the new home, move in, and then you can stage the old departing residence, make it look great, have it ready for anytime showings, open houses, that kind of thing. It just makes it a lot more marketable and easier to sell. And then the client has more of a stress-free transition into their new home. So, and then after that, home gets listed, and then you sell the home for full market value. Again, Calque is very similar in HomeLight that they do not want to buy the home. They are just putting this deal together so that our clients can remove the home sale contingency. They are not in the market to own and sell homes. So they give you 180 days to do that. Extensions can come into play as well. And there are some costs associated with it, the Calque program. So I can go through that real quick and do a quick screen share, and show what the breakdown of that looks like. Megan, I think you might just need to approve.
I stopped sharing
Cool.
mine and I just click approve, so you should be okay.
Got it. Yep.
Yep. Okay.
How's that look? Do we see pricing certainty?
Yep.
Very good. Okay, so this is the breakdown for Calque's pricing. It's very, very kind of simple. There's a flat $2,000 fee and a 1% of the guaranteed backup agreement fee as well. So if you have a $280,000 backup agreement for the home, and they tend to be very conservative based on what the market value. So maybe the estimated price might be 350, 400. You're probably getting an offer around 280K. That fee would total $4,800 in that scenario. So your 2% flat fee plus the 1% backup fee.
One thing I don't know if we touched on is, when is that fee paid?
That fee is paid at closing, so it comes out of the proceeds. So yeah, that's a good
That's
question.
a question I get a lot.
Yeah, we don't want to scare clients off, because that's usually the part of the problem too, is they don't have a ton of liquid assets ready to go to make these payments. So they can rest assured that this will come out of the big chunk of equity they have in their current home that's kind of locked up, right? That's the big problem these days. So, and what we can do is, here I'll do kind of a example transaction, so you can see what this looks like a little bit. So we have a 575 estimated true market value of a home that the client lives in currently. You can expect, like I said, a low ball offer, a guaranteed backup amount of $402,500. So it's going to be considerably less than what the home is actually worth, but it gets the job done. And in this case, we're saying $275,000 of a current mortgage balance on that property. You'll typically get that offer within 5 to 7 days of the loan officer submitting the documentation, the application needed, sending some pictures in, and kind of getting the process rolling. They're pretty quick about getting that offer back to us. And then you'll have the available equity of $127,500 to tap into for down payment and closing costs on the next property. And that part will come from the loan officer putting together either a Fairway Bridge loan or home equity line. You can look at a couple different options for the client to see what's most advantageous and cost effective for them. But in this case, you'd pay your $2,000 fee and the 1% on this $402,500 for $6,025. And then say you didn't need the extra money of $127,000 for down payment. They have a 401k or sufficient assets to put a down payment down on the new property. You can go with a simpler version of this and a more cost-effective way, where same scenario, 575 house, the 275 mortgage is all we're really worried about on the lending side of things, to omit that debt. So they'll give a GBA amount of 275 to offset that mortgage. That offer comes in within 1 to 2 days, very fast. So especially if something pops up to where you were trying to go contingent with a contingent offer, and a cash buyer, like Megan said, a cash buyer pops in, and then all of a sudden you're fighting to strengthen your offer, and you got to get rid of that contingency. We can put this together in 1 to 2 days. We don't tap into any equity, and then the price to your client, the cost is only the 2,000 plus this GBA of 275, the 1% of that. So it's considerably less. And if they owed even less, with a lot of folks do these days, that would make that closing costs even lower. So we'll use the HomeLight program and the Calque program kind of at the same time to figure out what is best for our clients and most cost effective for them as well. But very great program, allows you to get out and remove the contingencies on your offers, and had a lot of success with it.
Let me get back sharing my
Just another great option, really is.
Yeah.
Yep.
And it's nice to have multiple options too. I mean, just think about if you sat down with a client for a listing presentation and you offered them all of these options. And like I said, the other agent they were interviewing offered them none of these options. I mean, who are they going to pick? They might not use any of them. They might not need them or even be interested in them. But the point is we're giving them options. So it just helps.
Yeah, that's an important part too. I've done a lot of these, at least initiated, and got accepted approvals on HomeLight and Calque, but a lot of them we haven't had to use, right? Because the
You
home
don't
gets
have to
listed
execute.
and you don't have to execute it. They're kind of there as a plan B, because
Yep.
it seems like we're getting contracts in immediately again. Like it's that time of the year again. So a lot of times we don't even need to use them, but they're there as a plan B.
No, that's
Yep.
a really good point, because I've submitted a handful of these to, whether it's Calque or HomeLight, that wasn't really needed, but the deal still closed because there was no need for the contingency. It's just a good backup plan in case it's needed, or like your situation, Megan, with that cash offer coming in
Yeah.
to come and save the day.
Yeah.
Because in as far as the whole thing goes, let us as the loan originators explain the nitty-gritty to the client. And we could decide which option is best for them as we discuss it. We're just telling you realtors, I mean, that these options are available. Seriously,
Right.
it's
And we have all the marketing materials for you too. So we can co-brand flyers, and we have PowerPoints, we have videos. I mean, there's so many marketing materials that we can send you if your client needs some more explanation. And if you want to put actual marketing like in your listing presentations or buyer consults or anything like that, we have all of the marketing for this. But like Tony said, you don't have to be the expert. Like you don't have to be able to bullet point explain each and every guideline to these programs. Ultimately, hey, I have a great lender who offers these programs. Can, set up a phone call or something like that, so we can go through and educate them and see what product is going to be best for their situation. Because there's no black or white situation.
I've done a conference call with me, the buyer, the realtor, and HomeLight. All 4 or 5 of us on the call, just doing like a 10-15 minute Q&A, because sometimes that's easier than reading flyers and PowerPoints and stuff. And it just gets the client the questions that they need answered right away. And that's what we're here for. For all of these options, that's what we're here for, to make it easier.
Yep. All right, Scott, take us home.
All right. So this is a new product that we kind of launched like a month ago. It's in regards to helping seniors or their families, dealing with the parents or the kids who are helping the parents. A lot of times this is to help them move into, not to buy a new house. This is to help them move. You guys are selling their house for them. They're moving into an assisted living, a nursing home, moving in with their kids, whatever the case may be. But a lot of times facilities, nursing homes and whatnot, they want money up front as far as 1 or 2 months, call it rent, which usually can be $15,000-$20,000. They need to, unhoard the home. You need to get the senior out of it. They need to move, whatever the case may be. You need to do some repairs for them to be able to sell it. So this is what that is for. It's a line of credit, kind of similar to what everybody's used to. But here's the big thing with it is simply, if you look at a traditional line of credit, you cannot have the house on the market. You just can't. You can't have it on the market. You can't be putting it on the market. We don't care. The house can be on the market. You can put it on the market the next day. We know what the purpose of this. This is a short-term thing to help them get to that next stage in life, into that facility. So that's the biggest caveat to this. As far as the dollar amounts too, it can be as little as $10,000 to cover those short-term expenses to $50,000, $60,000. We also on this are not requiring an upfront draw. Most line of credits these days, whether it's us or anywhere else, require an upfront draw. If not 50% up to 100% of that line, then automatically you're making payments. So we don't do that. This is not the purpose of it. They can pull it when they need it, go up to 90% loan to value. It's going to be quick, streamlined, and whatnot. So it's interest only payments during the draw period when they use it, and when the house sells, they pay it off. And the other big thing that I will tell you is there are the fees that are on this is the third party, an appraisal, title. Fairway has no fees on this. And that's important because if you look at lines of credit these days now, there's typically some type of origination fee that all lenders put on it. Even the big banks, they have a 1, 2, 3, 4, 5% fee. Fairway is not doing this for an income stream for Fairway or for us as loan officers. It is technically a loss that we will take, but we have it out there because it's a need out there for seniors, but it's also a need that you guys have as realtors to help, again, whether it's a senior, but it's also their family. The kids, are trying to help figure this all out, and everything feels rushed, and they need $30,000 to get mom and or dad into the nursing home. Okay, house could sell for $400,000, but they need that money, so sell it for $350,000. Well, this takes that stress off. This allows them to slow things down, get mom or dad into that facility, whatever needs to be done, so it's not stressed, and decisions aren't being made out of urgency and needs. Just gives the family a chance to slow it down. So that's the whole purpose of this. And I will honestly say there is literally no product like this in the market, mainly because nobody's going to do something that's going to lose technically money for a company. So there is no option. You can look at other lines of credit, they can, but a lot of times they don't qualify. We're not going to take into account if they're going into assisted living and it's $10,000 a month. Like that doesn't impact the debt to income ratio or anything like that. So it's truly unique, something that we launched that I know in the senior community, there is a huge need. And you guys as realtors, again, another tool to offer, especially to seniors, their families, as they're going through potentially a difficult kind of challenging time with parents and whatnot. So that is that.
Great option for our seniors, really is.
Yeah, it's like you said, it's a need. It fills a need. So it really, really is helpful to listing agents helping seniors downsize or move or whatever. Again, it's another product to offer. And the cool thing about it, I think, is Scott G, you do a good job about reminding me of this all the time, is their kids are usually helping them. Right. So they might be moving into a senior facility. So yeah, you're not getting the buy, but if you service their parents well, those kids are going to come to you as well. So it's thinking, the bigger picture and widening your sphere with these things you can offer. So I think
one real quick thing with that too, if you are helping them move into, find out what facility they're moving into. Why? Our marketing on this is geared towards whether it's attorney, realtor, financial advisor. We have marketing that is purposely for assisted living facilities, nursing homes, and whatnot. And I say that because you could easily walk in there. It is co-branded with you and be out there. And you could say, hey, if you have seniors and families that run into this, here's our information. Let me know how I can help. This is a tool for you also to go and get listings, which I know everybody, likes listings. So this is a tool you can take if you know somebody or things like that. You can take this to your sphere, financial advisors, everybody, and say, hey, I have this cool product that the baby boomers, biggest demographic right now. So this not only helps your clients, but this can help everybody you do business with.
Mm-hmm. And second biggest demographic is millennials who happen to be their children. So if you're really talking about targeting, so it really is just some great things. So does anyone else have anything to add before we stop here? No? Okay. All right. Well, thank you everybody for listening. I'm going to stop the recording here as soon as I figure out how. There we go.